If you own a business, there's a tax that catches thousands of business owners off guard every single year. And the reason it surprises people is simple. Most owners don't even know it exists until they receive a notice, a filing requirement, or a tax bill they were never expecting. It's called business personal property tax. And no, this is not income tax. It's not sales tax either. This is a completely separate tax that can apply to the physical assets your business uses every day. Your computers, your office furniture, your equipment, your machinery, even your business tools in some cases. And depending on where your business operates, ignoring this tax can quietly become expensive. So in this video, I want to break down exactly what business personal property tax is, how it works in 2026, why so many business owners misunderstand it, and the mistakes that create penalties and overpayments. Let's start with the biggest confusion right away. When people hear property tax, they immediately think about real estate, buildings, land, houses. But business personal property is different. This tax generally applies to movable business assets, not real estate itself. Think about everything your business owns that helps it operate. Office desks, laptops, printers, manufacturing equipment, restaurant equipment, construction tools, business furniture. Those assets may be considered taxable business personal property, depending on your state and local laws. Now here's where business owners get frustrated. A lot of people think, wait, I already paid for the equipment. Why am I being taxed on it again? That reaction is extremely common. But business personal property tax is not based on buying the item. It's based on owning and using certain business assets within a jurisdiction. Now let's move into something important. Not every state handles this tax the same way. Some states aggressively assess business personal property taxes. Some have exemptions for smaller businesses. Some exempt certain types of equipment. Some have filing thresholds. And some states have reduced or phased out parts of these taxes entirely. This is why businesses operating across multiple states often get confused. The rules change depending on location. Now let's talk about how this process usually works. In many areas, businesses are required to file a rendition or property statement listing their business assets. That means reporting things like equipment purchases, furniture, machinery, computers, leasehold improvements in some cases. And here's where people make mistakes. They assume this is something only giant corporations deal with. Not true. Small businesses can absolutely be subject to business personal property tax too. Even a relatively small office may contain taxable business assets. Now moving forward, let's talk about valuation. This is another area people misunderstand. Many business owners think the tax is based on the current resale value. Not always. Different taxing authorities use different valuation methods and depreciation schedules. That means the assessed value may not match what you think the equipment is worth today. And this becomes important because inaccurate records can lead to inaccurate assessments. Now let's discuss one of the biggest hidden problems: outdated asset records. This happens constantly. A business buys equipment over several years. Some items are replaced, some are thrown away, some stop being used completely, but the records are never updated. So what happens? The business may continue paying taxes on assets it no longer even owns. And yes, that happens more often than you'd think. This is why accurate asset tracking matters. Now let's shift into another area that creates confusion: leased equipment. Some businesses assume leased equipment is automatically someone else's responsibility for tax purposes. But depending on the agreement and local rules, reporting obligations may still apply. That's why reviewing lease arrangements carefully matters. Now let's talk about filing deadlines. This is where many new business owners get caught off guard. In many jurisdictions, business personal property tax filings are annual requirements. Miss the filing deadline, and penalties may apply. And because this tax gets less attention online compared to income taxes, many business owners don't even realize a filing is required until they receive a notice. Now here's something important. This tax is not usually about finding loopholes. The biggest opportunity is accuracy. Accurate records, accurate classifications, accurate reporting. Because over-reporting assets can increase taxes unnecessarily, and under-reporting can create compliance issues and penalties. Now let's talk about organization, because this is where smart businesses separate themselves. Strong businesses maintain detailed asset schedules. That means tracking purchase dates, asset descriptions, costs, locations, disposals, replacements. And honestly, once a business starts growing, this becomes essential. Because the more equipment you own, the easier it becomes for records to get messy. Now, let's address something people often confuse. Depreciation for income taxes is not always the same as valuation for business personal property tax purposes. Those systems can overlap, but they are not identical. An item heavily depreciated on your tax return may still be valued differently for local property tax purposes. Different systems, different rules. Now let's talk about how businesses usually get into trouble here. Most problems happen for one of three reasons. First, they didn't realize filing was required. Second, they failed to update disposed assets. Third, they assume the government automatically had correct information. That assumption can become very expensive. Now let's step back and look at the bigger picture. Business personal property tax may not sound exciting, but operational taxes quietly affect cash flow. And when businesses ignore small recurring obligations, the financial impact compounds over time, especially as businesses scale. More locations, more equipment, more reporting requirements. Without systems, compliance becomes difficult fast. Now moving forward, let's talk about audits and reviews. If a taxing authority reviews your filing, documentation becomes critical. Can you support your asset records? Can you explain disposals? Can you verify purchase dates and values? Good documentation turns stressful situations into manageable ones. Weak documentation creates uncertainty. Now let's bring everything together. Business personal property tax is a tax applied in many areas to certain physical assets used in business operations. It is different from income tax, different from sales tax, and different from real estate tax. Depending on your location, it may apply to office equipment, furniture, machinery, tools, and other operational assets. The key to managing it properly is not panic. It's organization and awareness. Maintain accurate asset records, track purchases and disposals carefully, understand your filing obligations, and review assessments for accuracy. Many businesses overpay or face penalties simply because they do not understand how this system works. If this video helped you finally virtually understand business personal property tax, subscribe to our channel. We create weekly content designed to simplify complex tax and business topics for entrepreneurs, investors, and growing companies. And if you want more insights into business taxes, compliance, and financial strategy, visit gavtax.com for additional resources. Thanks for watching, and I'll see you in the next video.